Advanced financial reporting is one of the easiest area, and the moment we continue doing or practicing on what we have done in the past, we get used to the business, or we get used to the to the deal of how we go about the business. Now, friends, we want to continue with our revision. Still is the business of advanced financial reporting, and as I must have said, just in the most recent, before the break, we were looking at Friday, 26 May 2017 question, and that's the revision. We have already done question one, as we said. We are done in normal classes, done in the normal classes. The normal classes, that is one of the lessons as we were doing group accounts. Then we have question two, done in the previous lesson, done in the previous session. Just before the break, now we want to look at question 3. Now question 3, that's where we are. What is question 3 all about? Question 3 is all about that looks to be earnings per share. Earnings per share, that is IS 33. That's what we need to do for question 3, is about earnings per share. Now, in question 3, being the earnings per share, you need to remember that we have the basic earnings per share. We have basic earnings per share, which is simply the earnings attributable to ordinary shareholders. Then you divide it by the weighted average. Let me start with that. The weighted average number of ordinary shares, thing that we refer to Wanos. So Wanos or ones, that's what is the basic. While the diluted earnings per share, is simply the earnings attributable to ordinary shareholders from the continuing operations plus the incremental earnings divided by the Wanos. Remember, the Wanos from the continuing operations plus the incremental shares plus the incremental ordinary shares. That's it. And we should also remember to restated prior year earnings per share. Restated prior year earnings per share for comparison purposes. We simply take the earnings attributable to ordinary shareholders in prior year, then you divide it by Wanos of prior year, then you add free shares. You take into account the free shares. So that is mainly for the purpose of comparison. Now, without going into details, because this will be able to recap as we do the question, now we go directly to question 3. Judy Limited is an electronic company which has been listed on the Securities Exchange for the last 2 years. Provided below are the equity and long-term funds of the company as of 30th April 2016. Also provided are the income statement and statement of movements in reserves for the years ended 30th April 2016 and 30th April 2017 respectively. We have the equity and long-term funds as of 30th April 2016. We have the owner's share capital, 8 per value. We have the share premium, 6% preference share capital. We have the retained profits. We have the total equity. We have long-term funds as well. The income statement is given for 2016 and 2017. We have been given the revenue, profit before tax, interest on loan, profit taxation, profit for the year. Statement of movement in reserves, we will be given the retained profit for the year, preference dividends, ordinary dividend, and retained profit carried forward. Addition formation 1. On 1st November 2016, the company made a bonus issue of shares on a basis of 1 ordinary share for every 6 ordinary shares held. 2. On 1st March 2017, the company made a rights issue of 1 ordinary share for every 7 ordinary shares held. The rights issue price was 8.5 per share. The market value of 1 ordinary share on the date of the rights issue was 12.5 per share. 3. The 8% convertible loan stock can be converted at the option of the holders from the year 2022 at the rate of 125 owner shares for every 1,000 shillings of the loan stock held. 4. The corporation tax rate is 30%. 5. There was no issue of preference share capital in the year 2017. And 6. There was no issue of loan stock in the year 2017. Now, as we have been given there required, A, the basic earnings per share for 2016, the basic earnings per share for 2017, that's B. C, the diluted earnings per share for the year 2016 and 2017, then D, the diluted earnings per share. That is important. So C is the restated earnings per share, in other words. Then we move on to diluted earnings per share, and the whole of that will be 20 marks. So the basic earnings per share, straightforward. We A and B, we have done a recap, and the restated earnings per share we are going to do, but this one for rights issue, definitely it will take into account a different direction. Now, from the beginning, we have been given, if we are talking about the basic earnings per share, the earnings attributable to owner shareholders for both cases is given. For both cases is given because we have been given the profit for the year. And what we need to do there is to subtract the preference dividends so that we are able to get the profits attributable to ordinary shareholders. Then apart from that, and the preference dividends is given in the statement of movement of reserves. That is 30 million in either year. Then we need to calculate the Wanos. We need to calculate the Wanos in both cases. Wanos in this case will be affected by addition information. The number 1, there is some bonus shares. There are some free shares that were issued. They will not be weighted on time basis. But number 2, there is some rights issue, which part of it will be weighted on time basis, and the other part will be the free shares. Then nothing else. Only those 2 items, because number 3, they never converted the loan stock. Number 4, the corporation, that number 3, 4 will help us to compute the diluted earnings per share. But for the sake of the basic earnings per share, which is part A and B, we are able, even part C, we are able to answer that. Then we talk about it later. So we talk about the earnings. We have 2016 and 2017. We have the earnings, or is the other way around. If you use the other way around just as per the question, the better. The better. We have 2016. Then we have the profit for the year. Profit for the year. Profit for the year. For these 2, we have it that 630 millions, figures are in thousands. And this other one is that 185. So we less preference dividend for the year. Preference for the year only. And this one was given. We don't compute it from the statement of movement reserves. This is 30 and this is 30. So we could have adjusted profit attributable to NCI. Profit attributable to NCI is not there. We don't have it here. So we have this position. We have this position. We have earnings. We have earnings attributable to ordinary shareholders. So we have that for 2016 and 2017. So I can take simply that 185, if I'm not wrong, minus the 30. So that is that 155. And the other one is simply that 600. Perfect. we have the numerator for the 2 years. We have the numerator for the 2 years. That's what we are required to do, the basic earnings per share for the 2 years. That is A and B. It's like we're almost now working for A and B at the same time. Then we also look at the numerator, Wanos. Wanos. We need to get the Wanos. Let me start with the 2016. Wanos in 2016. Let me start with the 2016. Wanos in 2016. So first and foremost, we have the date. We have the date, the particulars, as we normally like doing it. Then we have the number of shares. Number of shares. Then we have the weight. We have the weight. And we have the Wanos. So the first item is on 1st. Our year begins on 1st May. 1st May 2015. 1st May 2015, they told us that the number of ordinary shares means that has been number of ordinary shares at the start. It was not given directly, but we have the total, that is 19.2 million. 19.2, you divide it by 8 bob. So how much would that come to? So I take 19,200 divided by the 8 shillings. That's the 2,400. That's the 2,400. The weight is simply 12 over 12, so that will remain 2,400. Then we come to number 2. Number 2, what transaction transpired in 2016? In 2016, there was only a bonus. That is on 1st November. 1st November. Is that the still 2016? No. That is in the new year. Because 2016, in note number 1, on 1st November 2016, the company made a bonus. 1st November 2016, and our year begins on 1st May 2016 and ends on 30th April 2017. So that's a new year. The previous year must have started on 1st May 2015 and ended on 30th April 2016. So it means that in this year, we didn't have any other transaction. Look at note number 2, that's for 2017. Nothing else. So for this year, we don't have anything. There was no other transaction. No other transaction, meaning our Wanos is the 2.4 million. Now, if we want to get the basic earnings per share, that is 2016, we simply took the 3,600, you divide it by 2,400. That's what you do. What you get, I take my calculator and realize that we can easily do that without so much problem. 3.6 divided by 2.4, and that is 1.5. So shillings 1.5 per share. So that is straightforward. We have got 1 shilling 1.5 per share. That is for 2016. Let's calculate the Wanos. Wanos 2017. Year ending 2017. So we have the date. This at least has some transaction. We have the particulars. We have the number of shares. We have the weight. And we have the Wanos. So number 1 is at the beginning, 1st May 2016. Number of shares at the start. Number of shares at the start, friends. We had already calculated that. So this is 2.4 million. 2.4 million. And then we have this is 12 over 12, then 2.4 million. Now something happened with addition information number 1. Addition information number 1, we have the there is a transaction that transpired on 1st March, no, 1st November, sorry, 1st November 2016. Then there is a bonus issue, and this number of shares was, what is the basis? Made a bonus issue of shares on the basis of 1 ordinary share for every 6. So 1/6 by 2.4. How much is that coming to? So we can calculate that. So 1/6 times 2.4, and that is 400. So we have the 400,000 shares. They are not weighted on time basis, so they are assumed to have been there from the beginning. So up to that point, we have the 2.8. We have the 2.8 shares. Then we come to number 3. Something also happened. Something happened, note number 2, on 1st March 2017. That is on 1st March 2017. On 1st March 2017, the company made a rights issue of 1 ordinary share for every 7 ordinary shares held. The rights issue price was 8.5 per share. The market value of 1 ordinary share on the date of the rights issue was 12.5 per share. Yeah, this is some work now we need to do here. So we know that there is a rights issue here. Some work need to be done, rights issue. And the rights issue, we have 2 items. There are those shares which are deemed to have been issued at full market price that will be, will be weighted on time basis. And there are those shares that will be considered to be for free. So friends, for those shares that will be considered to be for free, so this element has some weight matters here. So there are some shares deemed to be at full market price. Those considered to be full market price will be weighted on time basis, and this is they are saying that the company made a rights issue of 1 ordinary share for every 7 ordinary shares held. So there is 2.8, so 1/7 by 2.8. Let me put it in short because of space. 1/7 by 2.8 million. They're saying that this one, if you take 1/7 divided by 2.8, so I mean that is 2.8 divided by 7, that is 400,000. 400,000, and they have said that the rights issue price was 8.5 per share. The market value of 1 ordinary share on the date of the rights issue was 12.5 per share. That means that if we want to know the theoretical, because we need to multiply that, the 400,000 shares that we have got, we need to multiply that with the 8.5, but we divide it by the theoretical. We need to multiply that by the 8.5, the issue price, then we divide by the theoretical X-right price. What will be the theoretical X-right price? I'll want to create some space down here. The theoretical X-right price will be value of shares, before rights issue plus new funds due to rights issue. Then we divide it by the number of shares. Number of shares before rights issue. And this one, the value is, we take the 2.8 million, there is the price was 12.5 plus the value of the rights issue, we are going to receive 400,000 times 8.5. Let me put in short. The number of shares, 2.8 million. So what will that be? We are saying 2.8 million by 12.5 plus 0.4 times 8.5. We divide it by 2.8 plus 0.4. We get 12. So this is 12. So the theoretical exit price is 12.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.